What do you do with your money when inflation rears its ugly head?
Retail inflation for the month of July is at a 15-month high.
The July print for CPI, which has come in at 7.44%.
Markets tend to witness a sudden spike in the price of vegetables across the country.
तो ये टमाटर के दाम महंगे होते जा रहे हैं, जिसकी वजह से सीधा असर ग्राहकों की उनकी जेब पे हो रहा है.
Along with vegetables, there seems to have been a significant rise across food items.
कुछ और तो भरोगे टमाटर के अलावा?
इतना पैसा नहीं.
The big story this week is about inflation. Retail inflation hit 7.44% in July. In simple words, this means that the price of items that regular people consume on a daily basis, like food, clothes, fuel, tobacco, personal care products, health, etc., is now 7.44% higher than it was last year. Now, 7.44% is very high because the RBI, whose job it is to contain inflation, is expected to keep the inflation in a band ranging between 4 to 6%. And now that they're out of that comfort zone, you have to understand that the situation is a bit challenging. So we thought we could make a quick video explaining some things that you can do to your finances when inflation is rampant. And like always, please leave a like and a comment on this video so that the algorithm will share this article far and wide. With that out of the way, let's get to the story. Now, before we understand how to prepare for a situation like this, we have to understand why inflation is so high in the first place. Okay, primarily it seems the biggest culprit right now is food prices. If you look at the inflation rate and you break up the basket into all the items that contribute to this figure, you will see that vegetables have had an inflation rate of 37% and pulses at 13%. These two figures alone have propped up the inflation rate to 7.44%. So the question then is, why are vegetable prices going up? Well, let's look at what's happening in Himachal Pradesh, for instance. The rains have been extreme. Entire farm fields are underwater, and as a consequence, farmers in these regions have lost their entire produce. And this has been happening in several parts of India, not just Himachal. So the monsoons have affected supply, which is pushing prices higher. And this is translated to higher inflation. Now the question is, will this get any better? Well, the hope is that it will. But there's a very real possibility that inflation may remain elevated. And if it does remain elevated, then we must ask, what should we do to protect our finances? Now, most people I know will immediately go, oh, you need to beat inflation, oh, you need to invest in equity, stock, mutual funds, etc. Calm down. Before you start looking at investing, there are a few things that I believe most people should be doing. Let me give you my own example. I used to have very little idea about where and how I spent my money just a few years ago. I had some broad ideas, but I had never looked at it carefully. So let me tell you the first thing I would do in a high inflation setting. First thing I'll do, download all my bank statements, my savings account details, credit card statements, ATM withdrawals if there are any, and I will try and list down all my cash expenditures also. Then I will put everything in one place. I will go over each item in my bank statement, in my credit card statement, and then bucket these expenses into broad categories like rent, electricity, phone and communication, groceries, fashion, personal grooming, childcare, food, fuel, drinks, subscriptions like Netflix, transportation if you're taking cabs, etc., house maintenance. Anything that I can put into a category, I will put into a category, and then I will go over each category and see where I can trim down a few things. Like with rent, I can't do anything. My landlord will kick me out. But subscriptions like Netflix, I've used Netflix only twice in the last 1 month. I could definitely trim that down. Swiggy, Zomato, I could probably order fewer things as well. And while you can do this without having to write down every item and bucketing these expenses, I believe that the act of writing this down has a psychological impact. It makes it real. It makes it important. You can actually see the exact quantum of your frivolous spending, not just ballpark figures. Some things might even surprise you. Like when I found out how much I spend on Zomato and Swiggy, I was like, damn, I need to do something about it. And it all started by simply being meticulous and writing down everything that I'm spending. Now, this doesn't automatically mean you go Rambo mode and cut everything, okay? Like if you're enjoying the occasional ice cream, don't drop it. Have that ice cream. What you need to do instead is cut stuff that you feel is a bit excessive. Something that could help you improve your lifestyle and your overall finances. For instance, if you're spending some 2,000 rupees on traveling to your workplace every month and your workplace is only 1.2 kilometers away, walking could help. That's 2,000 rupees saved, and it's the same with eating out as well. If you're eating out pretty much every day, some degree of control could help massively. I also know people who maintain two separate accounts, a spending account and a salary account. So immediately once they receive their salary, they transfer some set money from the salary account to the spending account, and the spending account will only include the must-have expenses, which is like rent, electricity, groceries, etc., and maybe a small personal allowance for themselves. The savings remains in a separate account. My point is, if you're feeling the pinch of inflation, don't immediately start thinking about throwing money at equities. First look at your spending and see if you can do something about it. Okay? Good. Next, what do we do? Equities? Not yet. You look at your liabilities before you look at equities or investing. Look, most people watching this video will already have a home loan or an education loan or something like that. Or maybe you will have a home loan sometime in the future. And the thing about home loans is that inflation can have an impact on your EMIs. Let me explain. So usually when inflation remains consistently high, it's the RBI's job to make sure that the inflation moderates over time. And they have a bunch of tools to make this happen, right? So one of the first things they try and do is increase the repo rate. Meaning when inflation goes up, RBI increases the rate at which banks can borrow from the RBI. Since banks now have to borrow at higher rates, they usually pass on this cost to customers. So if you have a home loan, for instance, and you're on a floating rate regime, which means an interest rate regime where your interest component keeps changing over time, your interest rate will also go up once the repo rate goes up. वैसे even fixed interest rate home loans are also not fixed for the entire tenure. They also change in a few years. But my point is, higher inflation means repo rate usually goes up, and as repo rate goes up, the interest on any home loan linked to repo rate also goes up. But if you have a home loan, you may have seen something interesting. Even though inflation has been high and repo rate has gone up, your EMIs may not have changed. Well, this happens because banks, without telling you, will increase your total tenure. So if you're paying 30,000 every month in EMIs and you were expected to pay for 15 years, and now with the increase in interest rate, you will still end up paying 30,000 every month, but you will have to continue paying for 20 years. Your EMIs may only increase after any tenure extension is no longer possible. Like imagine after 20 years you turn 60 or 65, you'll be retired and you may no longer have the income potential to keep paying EMIs. So banks may simply ask you to pay a higher EMI instead of extending the tenure beyond this age. But for most people, the EMI increase usually happens only after tenure increases, and you may not even know this, which is why it's important to know what's happening with your home loan or any other floating rate loans you have. Maybe it's time to prepay a part of your loan. Maybe it's time to decide whether you want a tenure increase or you're okay with paying an increase in your EMI only. You have to think about so many things. So if you haven't done it already, please start thinking about it. Just because your EMI hasn't changed doesn't mean you're a lucky individual. It's likely that you now have to keep paying those EMIs for more years than you originally imagined. Luckily, RBI has introduced rules to make sure banks offer you the choice before they do anything to your tenure or your EMI. These rules are expected to take effect after December. So yeah, after that maybe you will know what's happening to your home loan anyway. Alright, now that we have finally talked about liabilities, we can discuss the final item on our list. How do I manage my investments when inflation remains high? Look, it's not that complicated. When inflation remains high, you have to first beat inflation with the investments you have. If you're not doing that, then you're essentially losing money. This is one of the reasons why most people don't recommend fixed deposits in a high inflation environment. Even though you may see fixed deposit rates have gone up in the recent past, very few of them beat inflation. So if you're planning on creating a fixed deposit, maybe it's time to rethink. I'm not saying this option is bad per se. Fixed deposits are all bad. No, it's extremely safe, convenient, and for many people, one of the time-tested ways of making money. All I'm saying is that don't expect it to consistently beat inflation. That's all. Next, investing in equities can seem very tempting in a high inflation environment. But there's a serious flaw in this argument. Like imagine right now, I decide to invest in Nifty 50 just because inflation is very high. And 1 year later, the index stumbles because of market turbulence. Then I won't end up beating inflation. In fact, I may lose capital. That's a very real possibility. So while it is true that equities offer you inflation beating returns in the long run, you have to plan for this ahead of time. Not when you begin seeing inflation, in fact. It doesn't matter what the inflation numbers are. If you are young, especially in your 20s or your 30s, you should have a large amount of your savings invested in equities anyway. Every month, set aside a good chunk of your savings in equities, and you will see that you automatically begin beating inflation when it crops up. And also, if you're looking to pick specific stocks, I think you could make an argument that some stocks perform better than others. Like some companies have significant pricing power. They can simply increase their prices if their input costs rise, and you won't see a big impact on their sales or margins. It's something that we discussed in this video while I explained ITC's business model. Their business verticals are largely inflation proof. Like cigarettes, even though sales of cigarettes have slowed down, their margins have improved because ITC has initiated several price hikes. And since smokers are sticky customers, profit margins from the cigarette business have been pretty decent even in a high inflation environment. And it's not just with consumer businesses, right? Even stocks in the IT sector and real estate aren't usually too affected by inflation. I know IT stocks aren't doing too well right now because of what's happening in developed markets and inflation concerns, obviously, but historically they have been pretty resilient in high inflation environments. Meanwhile, the real estate sector is actually booming, even though some developers are still struggling with stalled projects. However, considering the issues you generally have to deal with while buying land or property, I understand why most people don't want to invest directly in real estate. So that's also something you have to keep in mind. And finally, remember that the best way to beat inflation is consistency. If you're consistently saving and investing money, you really won't be in a position where you have to start worrying about inflation. You'll be well prepared for situations like these, and you won't have to worry about interest rates, repo rates, or any other number for that matter. And oh, there's one other secret that I forgot to mention. It's that if you are with a company or working for a company that offers you meaningful hikes that beat inflation every year, that would be an enormous plus. And as co-founder of Ditto Insurance and somebody who's actively looking to hire new people, especially advisors, since we are looking to scale our insurance advisory business, I can state very confidently that everybody in our team last year received hikes that comfortably beat inflation. And not just that, you don't need any prior experience in the insurance sector to apply here also, and you don't need to come to the office. It's work from home, and we will train you from the ground up. So if this sounds like an opportunity that you want to take, working at Ditto Insurance, working with people like me, please apply through the link in the description box below, or let your friends and family know about the opportunity. Okay, it will help us a lot. So yeah, that's it from me. Hopefully this video gives you an idea about how to deal with your finances in a high inflation environment. And if you like this video, don't forget to like and share this video with your friends and family again. I will see you next time. Until then, bye bye.